Tullow Oils announced a fifth oil discovery in northern Kenya following its exploration campaign across its acreage in the region. The company says that Agate 1 exploration, while in Block 13T, was found to have movable oil with an estimated 100 meters of net oil pay and good quality sandstone reservoirs. The latest discovery adds to discoveries in Twiga South, Ekales and Ngamia oil discoveries. Tullow will then move its rig to drill the Owa-1 Wildcat in the east of the basin. Other exploration activities include the Amosing-1 well, where drilling is expected to begin before the end of the month. Testing for the Ekales-1 well is scheduled to start in early December as Kenya seeks to join the League of Oil-Producing Nations. Tullow operates the Agate 1 oil with a 50% interest, while Africa Oil holds a 50% non-operated interest. South Africa's domestic airline industry is at a standstill as players wait for approval on a turnaround strategy for the national carrier SAA. This comes after the carrier made a $147 million loss in 2012. Its CEO then resigned, and the government has since fired the entire board, prompting questions on the future of the airline. CCTV's Angelo Coppola has the story.
There are several interested parties, including the international airline manufacturers. They are waiting for the sign-off because government will also provide the guarantees allowing SAA to buy and lease the planes they need. Meanwhile, SAA competitors and potential investors are looking for policy clarity.
Leaving the private sector in a very unenviable situation that they didn't know what's going to happen in the future, what their future would be, especially with the turnaround strategy that SAA has announced, what the impact of that would be on the market itself. And we would not like to see the private sector exiting the market and only be dependent on state-owned airlines. It's not what the policies are about.
The problems facing SAA are a fundamental cause of the stress in the industry. Many believe the local airline is not operating as a commercial business, getting significant capital injections from the state. The most recent, a $500 million guarantee.
The biggest cause on SAA is not passing on cost in its pricing. So non-reflective pricing is its biggest reason for its cost problems and why it makes losses. There's no reason that government should actually pay for that. That should be paid by its users.
There have been suggestions that the government has been acting disingenuously, which leads to further uncertainty and a lack of potential investor interest.
It seduces airlines into the economy, and it then subsidizes and competes and violates its own policy, which drives them out, 10 of them by now, out of business. And none of them have sued the government for damages. Now, it seems to me there must be a damages action against the government.
SAA is technically insolvent, but it can extract some capital by selling off its property holdings and getting rid of its older wide-body planes that are being used inefficiently on its domestic routes. But that's going to take political will. 2013 was a turbulent year in the South African domestic aviation market, and 2014 looks set to be the same unless the South African government changes tack. I'm Angelo Coppola for CCTV in Johannesburg.
Okay, let's have a look at early numbers in markets that we track here. If we look at Nigeria's all-share index, was 0.78% stronger. Moving on to the JSE all-share, which posted 0.08% weaker, and Nairobi's 20-share index was 0.5% in the green. And finally, moving on to the Egyptian Stock Exchange, which is closed on Friday.